In this video, I'm going to share the 10 incredible tax benefits of real estate. Now, if you're watching this, you already know that real estate's a fantastic investment vehicle, but you might not realize just how many tax benefits there are and how that can save you money and help you build more wealth. My name is Carson. You can also call me Coach, and I've been investing in real estate for over 18 years using the strategies and techniques I'm about to share with you. So let's get started right now. I want to give you a couple of quick tax law disclosures before we get into the 10 benefits. The first disclosure is that things change. Tax laws are very political. Even in 2021, when I'm recording this, there are winds of some changes that could come down depending on what happens in Congress and with the president. And so I just want to say that you have to keep an eye on this and that what works today may not work tomorrow. And because of that, you want to buy real estate based on its core economics. Tax benefits are kind of like icing on the cake. They're not the reason to do a real estate deal. They're something that can make it even better. The second thing is to get professional help. I'm giving you education here from the perspective of a professional investor, but I'm not a CPA, I'm not an attorney, and I actually have CPAs and attorneys on my team that I use to help me with my taxes. So I recommend you do the same. Now let's get into the 10 benefits. The first tax benefit I'd like to share with you is something called depreciation. I'll explain what it is and give you an example here in a second, but the benefit you want to know is that it shelters some of your income from taxes. It helps you save taxes by sheltering your income. Now, to understand what depreciation is, I'll start by reminding us something we all know is that nothing lasts forever. If you have a house or you have a mobile home or if you have a multi-unit property, over time is going to deteriorate. Nature, water, wind, just the materials themselves break down. And so the IRS, the Internal Revenue Service, acknowledges that by giving each type of asset, in this case, we're thinking about residential real estate, and for most of us, they give them a lifetime. So 27 and a half years is the official lifetime right now for residential rental properties. And all that means is that on your tax return, you get to take what's called a depreciation expense that is your total value of the building you're buying divided by 27 and a half years. So if you buy a building and let's say you bought a property for $250,000, $50,000 of it was the land. So you can't depreciate land, it's not going anywhere, but $200,000 was the building. You divided that by 27 and a half, you would have a $7,272 per year expense. So you spent all that money up front, but the IRS allows you to take an expense every year. Now this is a different kind of expense because this is what's called a paper loss. Paper loss, this doesn't actually come out of your bank account. You paid the $200,000 up front when you bought the property, but then every single year you get to have a $7,272 loss that helps you offset some of your income. So now I want to show you how that could actually save you some money in taxes. Let's imagine a scenario where someone makes $10,000 per year. Now that could be from their job, could be from some other investments, but this is their taxable income. And let's say they have a tax rate of 25%. So 25% of that income gets taxed. So 10,000 times 25% is $2,500 per year in taxes that person would owe on that $10,000. Now let's look at scenario B where $10,000 comes from a rental property instead of from that typical scenario. So $10,000 in rental income, and this is after paying like your operating expenses like management expenses and maintenance and insurance and things like that. And then you subtract this paper loss of $7,272, that's your depreciation expense. And so that, remember, that is on your tax return, and what's left over is $2,728 in taxable income, instead of that $10,000 in taxable income because of this paper loss. Now this tax rate of 25%, same tax rate, is applied to the $2,728, so you have a $682 tax bill instead of $2,500. So in this real simple scenario, that's $2,500 in tax versus $682 in tax. That's about a savings of just over $1,800 per year. Now in real life, you might have multiple properties like this. So maybe you have 3 properties and you have over $21,000 in depreciation expense that can then shelter the income you have coming in from all of those rental properties. Now there's more nuance to this. There's some exceptions, some caveats. In particular, if you make a lot of money from some other source like your salary, you can't automatically just save money on your salary income using the depreciation from your rental property. But it is clear that you can use any rental income you make and offset it with your depreciation expense. And this is a really big benefit. But I do want to talk about one more caveat with depreciation expense, and then we'll move on to the next tax benefit. The caveat I want to mention with depreciation is that what the IRS giveth, the IRS taketh away. And what I mean by this is you get the benefit of depreciation expense while you own the rental property, but when you sell it, you do have to pay a depreciation recapture tax. So you can essentially think about it like a loan, like you're getting to use that money, that expense, until you sell it, and that could be 20, 30 years, but then you have to pay it back when you sell the property, unless you use one of the other tax benefits we talk about here in the rest of the video. So keep on listening. There are some ways to avoid taxes when you sell. The next tax benefit I want to talk about for real estate is avoiding FICA or payroll tax. Now, this is something that real estate shares with other forms of investment income, like interest income from a CD or a bond, or dividend income from stocks, but it really comes down to the difference between earned income or investment income. So typically people, when you work a job or if you have self-employed income, like if you have your own business, if you make $100,000 and you're an employee, 7.65%, at least today when we're recording this in 2021, will go towards this payroll tax. So $7,650 if you're an employee, and then your employer pays the other portion of that. If you're self-employed and you make $100,000, you'll pay the 15.3% yourself, or $15,300. The difference is if you make $100,000 on rental income, you pay 0% payroll tax. So this is an investment income. Whether you make interest, dividends, or rental income, you're not paying that FICA tax. Now this is a big benefit because if you can orient your whole investment life, your financial life, so that most of your income comes from investments, then you'll save automatically that amount of money. So this is something I've benefited from over the years. I've made a lot of earned income as well, flipping houses, consulting, real estate commissions, things like that. And those just fit into that normal category. But over time, more and more of my income has come from rental income. And so that's a much more efficient way to pay for my bills and my lifestyle because of that tax savings. The third tax benefit is no tax on appreciation. Now, you all know Warren Buffett, the billionaire investor who famously says, "My holding period is forever." He likes to hold his investments over a long period of time. And in real estate, it actually benefits you to do the same thing. And the reason is, as long as you're holding the property and haven't sold it, so let's say you bought a property for $200,000, you hold it for 20 years and it goes up to $500,000 because of the overall market going up, because you bought it in a good location, maybe because you did a few things to it, you have a $300,000 potential gain on that property that you don't pay taxes on until you sell the property. So Warren Buffett likes to keep properties a lot of the time because they're more efficient to do that. That when you sell the property, you sell an investment, you pay fees, you pay commissions, and you pay taxes. And so by not selling, you avoid having a drag on your long-term growth. It goes up in value. There's some compounding and wealth building that happens because you're not selling. And so this is a common investment benefit with other investment vehicles like stocks and bonds and things like that as well. If they go up in value, you also don't pay taxes on the appreciation. And so this is a benefit that you get from real estate. The fourth incredible tax benefit of real estate is that capital gains tax, the long-term version of those, are at lower rates typically than ordinary income tax rates. Let me explain. So in 2021, as I'm recording this, there are 3 different brackets of how much capital gains tax you would pay if you were to sell real estate or other investments if you had a profit or a gain on that investment. If you were in the lowest 2 brackets, you would pay 0%, so you would pay no tax on your capital gains. If you moved up, you pay 15% all the way up to the maximum of 20%. Now this is in comparison to ordinary income from other sources. You would pay 10% at the minimum all the way up to 39.6% at the maximum. Now, this is one of those that's definitely subject to change. Could this go up? If you look at the historical rates, these are really low historically. So if you were a betting person and you want to look at probability over the long run, would it likely go up? Yeah, I would bet on that. And you should always think about that worst case scenario of how much you might pay in tax, and don't just look at what the current one is. But still, if taxes go up in the future, there's also a good chance that the ordinary income tax rates could go up as well. And so the benefit here, the reason why this is a benefit, kind of like not paying FICA tax on your investment income that I mentioned earlier, that buying and selling, or buying and owning properties and then eventually selling them over the long term is a very tax efficient way to do it. So even if you didn't buy and hold forever, like we just talked about, when you do sell a property, I've had a few properties that we sold in years where I had a lot of depreciation expense, I had a lot of other savings from taxes, or I just didn't make much money in that year, and we sold 1 or 2 rental properties, made some money, and were able to pay 0% capital gains tax, especially early in my career. But even if I paid the higher rates compared to what I might pay if I were having to make ordinary income, it's a big tax savings. So this is a benefit you should pay attention to, and another benefit of holding investments over the long run. The 5th incredible tax benefit of real estate is something called live-in flips, where you can potentially pay no tax when you resell a house that you live in. Now, if you're for the technical side of things, you want to look up Section 121 exclusion. Section 121 is a part of the IRS code that mentions this exception. But the way this works is that if you buy and move into your principal residence, so that's a key, it needs to be your principal residence, and if you live there for 2 or more years, and then you resell this property for a profit, you can pay no capital gains tax. The one we just talked about in the last benefit, you pay no tax at all, up to $250,000 if you're an individual filing as an individual on your tax return, or up to $500,000 if you're filing joint as a couple. Now, the reason this is a big benefit, whether you do it 1, 2, 3, or even more times, you could repeat this and build a lot of wealth. So let's say you make $50,000 to $100,000 because you improved the property. Maybe you did some painting and just cosmetic improvements. Maybe you expanded it. Maybe you redid the kitchen, or maybe just you owned it for a while and it went up in value. When you make $100,000 and you do that 2 or 3 times, think how long it would take to save up that much money from just earning an income and saving and setting it aside in the bank. It takes a lot of time to make that much after-tax money. And so I have some friends, Carl and Mindy Jensen, who've used this as one of their primary strategies early in their career, and they've actually continued to do that. And I have a video interview you can check out to see some of the details of their story. Mindy is one of the core people over at Bigger Pockets. Carl writes at 1500days.com as a blog, and I think you'll really enjoy their story if this live and flip tax benefit is something that you want to take advantage of. The 6th incredible tax benefit of real estate is something called exchanging properties tax-free. Now, again, if you want to look at the technical code for this and more details than I can cover in just the short time in this video, look at Section 1031 of the U.S. Tax Code. Now, just as an example to demonstrate this, let's say you bought a property 5 years ago for $200,000, and the property's appreciated, done really well. So it's a single-family house, and this market's just gone crazy. So you have a $500,000 sale, but you would have a gain, a capital gain that we just talked about earlier, of $300,000. Plus, remember, you'd also have to have some depreciation recapture. So you benefited from depreciation while you rented that property, but now you have to recapture that and pay a tax when you sell. So just approximately, depending on the situation, maybe you'd have a $70,000 to $80,000 tax liability if you were just to sell this property straight out. But instead, if you did a 1031 exchange, and there's a set of rules that you need to follow that you would study before you did one of these, and you have to have an intermediary who would help you hold the money between when you sell this property and when you buy the property, and there's some timelines you have to take into account there. But let's just say you bought a multi-unit property with that money for $500,000 or more. You could put more money into it and maybe buy it for $700,000 or $1 million. But the point is, you take that entire gain and the entire sales price that you had for this property, plus maybe if you had some debt on the property, you'd replace it with some debt on this property. The point is, equal or greater value, you could pay no tax on all of that gain, and you could defer all the tax on your capital gains and your depreciation recapture. So it's kind of like you're getting a loan at 0% interest indefinitely until you do sell the property or until you die, which I'm going to talk about in the 10th tax benefit. But you get to defer and use that $70,000, $80,000 to buy this property for $500,000. So that's a big benefit. That money would be gone. It would not be available to you. But now, let's say you make a 10% return on that $70,000 or $80,000. You're making a $7,000 to $8,000 per year return on this money that you're deferring and not having to pay taxes on. So that is how you build wealth, by being very efficient with the sales of the properties. Remember how Warren Buffett doesn't like to sell, but in real estate, you can sell and do an exchange like this and still have some tax efficiency. So 1031 exchanges, tax-free exchanges are another tool in your tool belt to have the benefits of taxes when you're investing in real estate. The 7th incredible tax benefit of real estate is something called an installment sale. You might have heard it also called seller financing or owner carryback financing. And what this allows you to do, in short, is to defer the capital gains tax if you have a big gain on the property you're selling. It actually doesn't allow you to defer or save any money on the depreciation recapture tax, which we talked about earlier in the very beginning. You actually still have to pay that on this, so that's not a benefit of this particular tool. But just to give you an example, let's say you bought a property 30 years ago for $50,000. So you owned a property for a long time, is now worth $300,000. You'd have a $250,000 gain that would be subject to capital gains tax. And another problem with that is if you made all that gain at one time, and so this is especially important if you have big properties and you're making $1 million sale or something, and a lot of properties go up in value over time to that amount, then you would have a big gain that would also push you up into a higher tax bracket because you make a lot of that money in 1 year. What an installment sale allows you to do is that you pay taxes just on the portion you receive that year. So let's say you receive a $30,000 down payment, which is 10%, and then you get some principal each year if you finance that house. So every time somebody makes a payment, some of it's interest, some of it's principal, and you would pay taxes on the interest portion you receive, but then the principal portion, you pay taxes based on how much you received that year. So like in year one, you might receive $34,000 in this case, year two, $4,100, year two, $4,200, so a little bit more every year. And there's a formula that you would apply based on what your basis is on the property. But the point is, that is the amount of money that's exposed to taxes. And then you'll pay some tax rate based on a portion of that. And so you can avoid getting the $250,000 gain in 1 year and just get the $34,000, $4,100, etc. down the road. So it's just another tool to help you spread out the impact of the taxes. And just as an aside, I love also selling with seller financing. Over the years, we've sold several properties just because of the transition it allows you to make from being a rental property owner to more of a passive collector of interest. So we've sold a lot of our properties to tenants over the years and let them make a down payment to us after they demonstrated their ability to pay. And then we now have notes or seller financing notes where they're making payments to us over the years. So as a business decision, it can also make sense, but there is this particular tax benefit as well. The eighth tax benefit of real estate is that you can borrow tax-free against real estate instead of selling. So we've talked a lot about these scenarios of you needed to raise cash and you sold a property, but there's also a case for not even selling it, for borrowing money instead. So let's say you paid a property down and maybe even paid it off, which I like to encourage people to do. And why would you actually borrow money if you needed some cash? Well, the first is maybe you want to keep a good property. You've taken a lot of time and effort to find this good location, this good property. You like the bones of the property. It's low maintenance. So why not just keep it by borrowing the money? The second is you can now, after you borrow that money, you can allow the tenant to repay the loan. That's one of the big benefits of owning real estate in the first place is that you have this amortizing loan. And if your tenant pays every month over a long period of time, they're helping you to build equity and repay the loan. The third is future appreciation. So as the property is a good property, you might just want to keep it. And so you get the cash by borrowing it and then let the property go up in value over time. And then relevant to taxes, when you borrow money. So if you borrowed $100,000 from your property, you pay no tax on that borrowed cash because you haven't earned it. It's just borrowed. And this is interesting enough. This is my plan for our paying for college for our kids. If we're going to help them pay for some of their college one of these days, my wife and I have 2 different properties that we've sort of earmarked or set aside saying that equity, at least part of that, is going to be for helping our kids pay for college. Now, do I want to sell these properties? Do we want to sell them at some point? Maybe. We're not really 100% sure. But at this current time, what I'm thinking is when we get to the time where it's time to pay for college, we would just borrow the money against that rental property and then use that money to help them out with the college and then allow our tenants to repay it, keep the property, let it go up in value. And it's just a lot easier to time, and there's not the implications of having to find a replacement property and do something else with it. So that is actually my plan for one particular financial need that we have in our life. The caveat of this, as with every strategy, is there's some risk. So there's a risk of borrowing money. There's risk of debt, and that's a real risk. I think is a healthy balance if you do it correctly. If you fix your payment over the long term, you get a long-term interest rate. If you build up some reserves, if you have a margin of safety, so don't just borrow right up to the most you can borrow. Make sure there's a nice cushion of cash flow between what you're paying and what you have coming in. You always want to have some reserves and some cushion there. But if you do that, I think you can sleep well at night. At least that's the case for me. But if you don't like the risk of borrowing money, then maybe this isn't a strategy for you. But this is just one of the tools that's another tax benefit of investing in real estate. The ninth incredible tax benefit of real estate is something called self-directed retirement accounts, which includes IRAs, 401ks, HSAs like health savings accounts, and others. And you might have only heard that in your retirement account, you can only invest in stocks and bonds, right? Traditional investments. Well, that's not true. There are self-directed IRA custodians. And those of you who followed along with me a lot know I use somebody called American IRA. You can see a link to them in the description below. But American IRA and others, they're typically more kind of boutique custodians, smaller custodians who allow you to move some or all of your retirement money over to their custodial account. And you can buy rental properties, flips, you can make loans, which is probably what my favorite is. I've done the most of. I've made loans to other investors. You can buy into limited partnerships, like private local partnerships that buy real estate. You could invest in crowdfunding platforms. You can invest in tax liens, which I have also done. So a variety of different things. If you feel like having control over your investments and wanting to know where you're putting it, and you feel like you could go out and find some good deals that would make sense for your retirement account, this is a benefit of being able to invest those funds into real estate. The caveat here is that there's some strict rules that you have to follow. As with any good benefit, you got to follow some rules. But in particular, if you, for example, loan money to a family member who you're not supposed to, or you do anything that's kind of self-dealing, there's a whole set of rules you want to study and pay attention to. And you just want to be careful. There's some big penalties if you do that. But if you follow the rules, if you use the right custodian, this can be another incredible tax benefit that allows you to build wealth efficiently and not pay as much tax while you're renting, flipping, loaning money to other people. The 10th and final incredible tax benefit of real estate is to die with your real estate. Seriously, not exactly a good life strategy to go before your time. Now, we're all going to die at some point, but there is a tax benefit whenever that does happen, at least for your heirs. Not for you, you're gone. But your heirs get what's called a stepped up basis. And let me explain what that means and why that's important for you from a tax standpoint. So let's say you have a property that's worth $500,000 and you have a very low basis because you bought it a long time ago and it's gone up in value and you've depreciated it down of $50,000. So you have to deal with a $450,000 gain. And as you've seen in all the other tax benefits, when you sell a property, you have to pay tax on that. And there's also the depreciation recapture tax. Well, your heirs, when they get a stepped up basis, what that means is their new basis in the property is actually the same as the value of the property at the time that you died. So instead of having the $50,000 basis, they get it stepped up to $500,000. So it's like they bought that property at the time you died, and they bought it for $500,000, although it was gifted to them, it was given to them. So if they were to turn around and sell it day one, they would pay 0 capital gains tax and 0 depreciation recapture tax. That's an incredible benefit for them. Now, just a caveat, just so you know the whole story, there is something else called an inheritance tax, and that goes up and down as another political kind of whirlwind. You have to just pay attention to the times on what that is. But currently, when I'm recording this, I believe it's over $11 million in exemption. So you could inherit over $11 million or up to $11 million in real estate, other assets, and pay no taxes on it. If it's above $11 million, then you'd pay taxes. So for the most part, for most people, the inheritance tax actually doesn't come into play, and you get the stepped up tax basis, which means you would pay 0 capital gains and 0 depreciation recapture. Your heirs would whenever they turned around and sold it. So there is a happy ending in some cases, at least when you can think about your heirs if they were to inherit that property. As you can see, there are many incredible tax benefits to owning and investing in real estate. My final point I want to make is one that I started with, is as you invest in real estate, be careful not to let tax benefits be the main reason you're investing in the first place. It's kind of like that expression, don't let the tail wag the dog. That big fluffy creature, the dog, is the main thing, and that tail just follows along. And so tax benefits are like icing on the cake. Other benefits, like the rental income, like the amortization of your debt, like the growth you can get from owning real estate, are there and they matter whether you have the tax benefits or not. And this is an important point because sometimes if you get so focused on tax benefits, you might forget that, you know what, paying taxes on this property and enjoying that money and using it and spending it might actually be okay. that your whole life doesn't have to be optimized. And in some cases, there's some balance in that making a life decision versus only an optimization decision can make sense. The other final point I want to make is that with all of these tax benefits, with applying them and using them, having a professional on your team is incredibly important. I have a CPA, I have attorneys that I talk to and I use and I pay for their time because they help you with some of these things that can make you a lot of money. And so don't be cheap, don't try to do everything yourself. Use a professional, hire an attorney, hire a certified public accountant, a CPA to help you on your team to apply these tax strategies. I'd love to hear from you in the comments section below. Which of those 10 tax benefits is the most valuable to you? Which one would you like to use, or maybe you've already used in the past? And if you like this video, be sure to hit that like button to help us spread the word on YouTube. If you're new to this channel, be sure to hit the subscribe button and the little bell so you don't miss anything. I have new videos that come out every Friday morning. And if you like this video, I think you'll also like the next video, which goes back and analyzes my very first rental property and shows you over a 17-year period all the ups and downs, how much cash flow I made, and I have a spreadsheet to show you exactly how the return was over those 17 years. So if you like the behind the scenes of real estate, check that video out. I think you'll like it. You've been watching Coach Carson TV. My name is Chad Carson. You can also call me Coach. And this is a channel all about investing in real estate, achieving financial independence, and doing more of what matters. See you next time.